Good morning, everybody. Welcome to this Conservative Home Savings, Pensions and Investments Conference. For those of you who don't know me, I'm Angus Parsad-Wyatt, Chief Executive of Conservative Home, and it's my pleasure to welcome you all here today. And to those watching on the live stream as well, thank you for joining us this morning. I also want to start by extending a very special word of thanks to our sponsors today, Hargreaves Lansdown. Thank you very much for your support and helping to make this event possible. I should add that nothing covered today constitutes formal financial advice. If you're here for that, ignore anything. Well, don't ignore, but it's not legal. So, but do speak to Hargreaves Lansdown or others afterwards. So we come together today to explore the future of savings, pensions and investments in the UK. As Conservatives, we recognise the importance of building financial resilience and preparing for what lies ahead, both economically and politically. These topics are not just relevant, but vital for all of us in seeking to secure a prosperous future for ourselves and future generations. Our mission is to empower individuals, fostering a society where personal responsibility and opportunity go hand in hand. In today's rapidly changing landscape, it is crucial that we equip ourselves with the necessary knowledge and skills to navigate the financial challenges we face. Throughout this morning, we'll delve into the structural challenges and opportunities that lie ahead for our country. We'll discuss the policies, investments, financial education and digital skills needed to adapt to the evolving financial planning landscape, and we'll explore the potential impact of emerging technologies such as AI and crypto. In addition to our esteemed first panel that you see beside me here, we're delighted to be joined later by the Economic Secretary to the Treasury and City Minister Andrew Griffith MP, and also the Minister for Pensions Laura Trott MP. Briefly, before we jump in, I want to cover a few housekeeping points. There are no planned fire alarms this morning, so if the alarm does go off, please leave via your nearest exit, the best cabin crew bit. Please ensure all your phones are set to silent so we don't disturb any of the sessions. There will be opportunities to ask questions from the floor during each of our three sessions this morning. Please do engage, please do ask questions, but please make sure they are questions. Anything which starts with, it's more of a comment really, will not be welcomed by any of our chairs today. There will be two breaks, so a short one after this first panel, that's a quick kind of comfort break whilst we change the staging around, and then a slightly longer one later on. So I'm delighted to introduce our first panel, Into the Unknown. We're navigating economic uncertainty, building financial resilience and preparing for the future. Leading our discussion for this first panel is the brilliant Emily Carver, one of Conservative Home's regular columnists and a familiar face to GB News viewers. Emily will guide us through this broad look at the UK economy and how we can empower people and businesses to be more financially resilient. Once again, thank you all for joining us today, and without further ado, please welcome our first panel.
Thank you very much, Angus. Thank you for inviting me to chair this panel. It's a big one. It's a big topic we've got to cover here, so we've got not too long, but we'll try and get through all of it. So I'm Emily Carver. I write for Conservative Home regularly, every fortnight. I write about economics, culture wars, society, anything really, everything and everything, of course, politics as well. So on the panel, I'm delighted to say that we have Dr. Gerard Lyon to my left. He is Chief Economic Strategist at Net Wealth. You've advised all sorts of very high-profile politicians, and you are also a board member at the Bank of China, amongst other organisations, and Senior Fellow at Policy Exchange, the fantastic think tank. We also have Leon Ward, Chief Executive at My Bank. That's a UK charity that delivers expert-led financial education programmes to young people from age 5 up to 25 years old. I'd be interested to know what you teach 5-year-olds in finance, about their future mortgages perhaps. Then we have Rebecca Deegan, who is Head of Protection and Health at the Association of British Insurers. She leads a number of initiatives that demonstrate the important role insurance plays in building financial resilience. And we also have Tom Harrison, who is Public Affairs Director of Financial Regulation, and he is also an ex-Bank of England analyst. And lastly, Ed McGuinness, President of Conservatives in the City, which is a professional networking organisation for people who work in finance and professional services, as Ed himself does. Well, thank you very much indeed for joining us. Seeing as we've got Gerard on the panel, I think that it would be nice if you set the scene of what the economy is looking like now. We have quite a lot of doom and gloom. Where do we stand?
Okay, well, thank you. Well, it's great to be here. Thank you for the invitation to speak. Maybe if I could focus on three, or keep it brief, I'll focus on three parts. interest rates, inflation, and growth. First, interest rates. The key story, whether one's looking at the UK or any country in the Western world, the key story is the end of cheap money. Since the 2008 global financial crisis, we've become used to cheap money. The quantitative easing in the immediate aftermath of the global financial crisis was justified. The prolonged period of cheap money since was not justified, and indeed in the last couple of years, in the aftermath of the pandemic, central banks basically did the wrong thing, which exacerbated the current inflation situation. So we're now seeing the reverse of cheap money. That's already exposed problems in the financial sector, as we saw here last autumn with the LDI crisis in the UK, and as we've seen in the last few months in the States with regional banks. We're yet to see the full economic casualties from cheap money being ended. Remember, it takes somewhere between 12 to 18 months for the full impact of monetary policy tightening to feed through. Unfortunately, central banks keep responding to the latest data, and they seem to overlook the long time lag it takes for previous tightening to feed through. So the first key message is we're seeing the end of cheap money, and that is a very challenging time, therefore, not just for the UK, but for Western economies. The second issue is inflation. A few years ago at Net Wealth, we did a piece and we asked which P is the inflation we're seeing. Will it pass through? Will it persist? Or will it become permanent? We thought the Bank of England and other central banks were wrong to conclude that the pickup in inflation would pass through. We felt it would persist. We didn't think it would become permanent. And what we are now seeing is the two factors that led to higher inflation in the last couple of years being unwound. The supply side factors linked to the pandemic and linked to the war in Ukraine are being unwound, and we're seeing commodity prices, oil prices in particular, well off their peak, transport costs internationally well off their peak. And also we've gone from low interest rates to much higher interest rates, as I've already mentioned. Inflation, therefore, should decelerate quite significantly. Where it settles remains to be seen. In all likelihood, inflation over next year will undershoot before settling somewhere higher than it was pre-pandemic. Pre-pandemic, we were used to inflation of 1 to 2%. I would not be surprised if we become used to inflation of 3 to 4%. The second round effect of inflation is where the central banks are focusing their attention now, but this inflation cycle was not caused by higher wages, and we should bear that in mind. And third, very briefly, what does that mean for growth? Here in the UK, 6 months ago, the expectation was that the UK and indeed economies in Western Europe would suffer recession. I thought that was too pessimistic. We're avoiding recession, but growth is still weak. The negative will be the impact of cheap money ending and higher interest rates feeding through. That will take the heat out of the economy. The positive is that as inflation decelerates, that will boost real incomes quite considerably. And indeed, for those who are conservative-minded in the audience, that's where the big hope will be. But also on top of that is the global backdrop. And the next few months might be very challenging indeed. The US economy could actually fall into a technical recession. It's already weakening. China, which is the other major locomotive of the world economy, has already in the second quarter exhibited two speeds. One part, the service sector is still growing strongly. The other part, the manufacturing sector, is weakening. Add in sanctions and the Chinese economy will lose momentum. So next few months, the world economy will appear to be slowing, markets will become more cautious, and that will add to pressure for the Fed and other central banks to maybe start cutting rates before year end. So 3 points. Cheap money ending is the big challenge. We're now in an era of much higher interest rates. Second, inflation is decelerating, but it's likely to settle at a higher level than people think. And third, the growth picture will be impacted by all of this. The positive is inflation falling, the negative is higher rates feeding through, and the unknown being how the world economy impacts us. But it's likely to be sluggish over the next few months. Thank you.
Well, there you go. Allow a round of applause for that. You set it out very, very well indeed. A very challenging economic landscape, Leon. So in the work that you do in terms of teaching about financial resilience, financial education for children as young as 5 up to 25, Do you believe it's particularly important where we are sitting now in terms of the various challenges we face? Low growth, interest rates rising, etc., etc.
I mean, it paints a pretty dull picture if you are a primary school student, hearing things like cost of living crisis, potentially overhearing your parents talking about the cuts that they have to make and potentially seeing it in your household. And young people, children and young people, aren't ignorant to what's going on. Recent Prince's Trust research said that 64% of young people say that being financially secure is one of their biggest goals in life. So the majority of young people are already thinking about their own financial situation. One of the things that we do or that my bank do in all schools that we work in from 5 to 25, which is the age range that we work in, is it's about teaching good money habits for young people. So getting them off really early, thinking about where money comes from. So these are just basic things. Money when you're 5-year-old typically comes from your parents and your grandparents and family members when it's your birthday, etc. And as you grow older, you then get income from different means. We're obviously talking about microeconomics here, where you get, I don't know, a £5 for helping put the shopping away or whatever the
Sorry to interrupt on that
inflation
one,
rate is.
but I read in the paper earlier this week or last week that children are receiving inflation-busting rises in their pocket money.
Yeah, so
which is quite interesting.
Maybe it's 10 quid
perhaps
then
not with
instead.
wages, but
Yeah.
with pocket money.
And I think the challenge is that not only is it about teaching good money habits from really early on, hoping that those then bed into somebody so that when they're older, they understand that you can't live beyond your means, especially with the end to cheap credit. Although having said that, one of the things that we are seeing with younger people is buy now, pay later is booming, and people not budgeting for when the pay later kicks in because they just see it as 3 months down the line, and before they know it, they've spent hundreds of pounds. That then becomes a bill due in several months. So we teach a whole range of subjects to children and young people. The key is about building good money habits when they're young, with the hope that that then prepares them better for their future. And it does. Our work shows that it does. Our research shows that after Money Works, which is our program for young adults, there was a 60% increase in young people who have savings and a 50% reduction in young people running out of money because we had taught them how to budget within their context. And that's the other point, which is that financial education has to be context dependent for the young people. So the call for maths maths up until 18 from Rishi is a good call. We back that call, but we would like financial education and resilience and capability training to be bedded into the curriculum with suitable time in the curriculum, which is the never-ending challenge in the school sector, and a skilling up of the workforce, because actually lots of teachers don't know how to manage their own budgets and household income. So that's the perspective from our side, you know, on the coalface of it, where every day in the classroom with children and young people, they hear what's going on, they're worried about it, but really we've got a captive audience. If 64% of them are saying, I want to have a financially secure future, then surely they're the right people to talk to about financial management and education.
Well, definitely, and I imagine, well, I very much agree that economics, financial management, basic accounting should be taught at school, and it's a bit of it's an outrage almost that it isn't, because children are going into life not knowing the difference between, you know, interest rates, mortgages, whatever it is, inflation, etc., and just how to basically budget. Rebecca, you work at the Association of British Insurers. How important is it that young people and adults throughout their lives understand the importance of financial resilience, the importance of investment, and having a secure future?
Yeah, sure. It is absolutely a lifelong endeavour from a young age all the way through to post-retirement. We have a number of insurers who run similar projects, who go into schools and support young people to learn the basics of how the financial system works. As you were saying in terms of context, Leon, I think for many people they're not going to think about different types of products that are available until they reach that point in their life as well, and they have the context within which to make those decisions. Once people leave education, obviously they go into the workforce, and from our perspective, employers play a really key role in helping people with their financial literacy to build their financial resilience and acting as a trusted intermediary between financial services and products that they might find confusing, and being supported to access those types of products through their employer. auto-enrollment has been a great success. We've got more people saving into a DC pension pot than ever before, and I was reading that we've got more people who are Gen Zs, they're the ones after me, saving into a pension than millennials or boomers were at that age.
That's interesting.
Yeah.
So they're more financially savvy.
Well, they're just being auto-enrolled, I think, but they're benefiting from that. But they are generally more tech-savvy. And the fact that we are looking in the pension space as well at things like pension dashboards, which they can then engage with through technology, will help them to have more financial resilience and better financial literacy than earlier generations who had DB pensions. You know, they finished work and they knew they were going to get a pension to retirement. But the concerning thing is that we're seeing people who are accessing their DC puts now, accessing it without advice and guidance. We were chatting earlier about pension-wise and the low uptake of that. I think it's about 13 or 14% of people who access their DC pensions access pension-wise. But 9 out of 10 say it's a really great service for helping them to figure out what to do at the point of retirement. So I think it is a lifelong endeavour. There's a really important role for schools, really important role for employers, and a really important role for providers and the pension sector more broadly.
Yes, I think a lot of people just, cross their fingers and hope for the best,
Yes.
particularly in their younger years. Just on that, because the way people work, particularly younger people, but in general across the labour market, people are adopting different work-life balance. They don't have the traditional employment where they're paid PAYE throughout their life.
Yeah.
How do you go about advising people? I mean, myself, I've moved from jobs, salaried jobs, to freelancing, to all sorts. So,
it poses a number of challenges. One is that we will have lots of different employers throughout our lifetime, so lots of different pensions. That's one of the things that is hoping the pensions dashboard will enable with, that you'll be able to see all of your pensions in one place and perhaps consolidate them if that makes sense for you. And also to identify lost pots. The ABI sponsored some research by the Pensions Policy Institute last year, and it found that 2.8 million pension pots are considered lost, and that's an increase of 75% over the last 4 years, and equivalent to £26.6 billion that people have not, I guess, taken with them from employer to employer. And then on the self-employed front, so the IFS did some research, and only 16% of self-employed people are saving into a pension. And if you freelanced as well, I don't know how you found it. I work at the ABI part-time, and I freelance part-time as well, running a similar organisation in terms of teaching young people about politics and finance. And for that part of my income, it's up and down, and I don't know how to figure out the best way to put it into a pension. And I'm someone who's quite financially literate. And I was thinking about this ahead of the panel, if there was a way around my self-assessment that I could sit and look and think, okay, what's the most tax-efficient way to put into a pension for my last year's savings, that could be a really useful vehicle for me. I think there's lots of challenges by the change in working.
yes, I think with self-employment, and when people are starting out as freelance, you do often, make a lot of mistakes and end up having to pay more than you ever thought you were going to. So a little bit more education on that would certainly not go amiss. Ed, you are president of Conservatives in the City. So this is presumably you talking about financial resilience, talking about the economy with all your different members and pals at the Conservatives in the City. So in terms of that financial resilience, is that something that you are focused on?
Yes, thanks, Emily. I think the panel's brought up a number of interesting points. With our networking group and with everyone on this panel, and perhaps a lot of people in this room, we are quite financially literate already, and I think the people that we need to focus on are those people that maybe don't work in finance or in large multinationals, which have the capability of providing very good pension plans, very good visibility on personal pension plans through dashboards, which I know was mentioned before, or other sort of communications to their employees. And so I think, I know it was touched on before with Leon and my bank. I think the work they're doing is fantastic by engaging with people early, building a financial literacy amongst the population, which I think is hugely key. And I'm a big proponent of Rishi Sunak's maths prioritisation, although I am a maths grad, so I don't want to dive too much into sort of fanboying on that particular policy. But maths and comfortability with numbers and statistics is hugely important because it's the language through which we operate our financial system. And so embedding that into the curriculum and embedding it through other maybe non-traditional subjects like geography, history, making people comfortable with understanding how statistics work and what that means, and making them unafraid to challenge data and to understand their own particular financial position is key. And then just sort of, sorry, I seem to have gone up in volume there. Just sort of one last point on pensions themselves. You know, it would be interesting to know how many people in here actually know how much is in their pension pot right now versus those of us who are lucky enough to have, or unlucky enough to have, mortgages at the moment, and how much we have to pay off on those mortgages. But your pension is your biggest financial asset potentially, other than owning a home. And the fact that we, even those of us who work in the industry, you know, might not be as on top of that as we should be, is a real indication that we need to move further in terms of making people more aware of what assets they have and what assets they'll eventually need should they wish to retire.
Tom, you're an expert in legislative affairs and regulation. You've been an analyst at the Bank of England. What do you think the government should be doing to improve financial education, to make sure that people aren't going to be bankrupt by the time they finish work? Because we know that the state pension is going, it's not going very far for many people. Yeah. And there's a lot of young people who won't ever potentially own their own property. So that's another difficulty. They don't have that asset to fall back on.
Yeah, so, I mean, I think just to take us back to the macro picture initially, I think the most important thing the government can do is sort out our very sluggish growth that we've been living with really ever since the financial crisis. That we were kind of in a period what was meant to be kind of uninterrupted growth. We were averaging kind of 2% a year, never really going back to our kind of long-term post-war average of 2.5%, which was obviously, that was going through various periods of recession. So I think the most important thing we can do is sort out our growth. And I think there's a whole range of factors going into that I'm sure we can discuss, but it's things like tax, business investment, regulation, skills, the planning system, dare I say. Decisions in all these areas kind of add up. In terms of, and then I think that will obviously kind of feed through to a lot of these kind of downstream issues that we're talking about in terms of financial resilience. I think we've heard some really, really good points from various people on the panel. I'd say one thing I'd say is that I think there are very different solutions depending on where you are in the economy. For some people, the answer might be, okay, we've got a higher interest rate environment. Maybe you can start look at kind of saving again rather than being a borrower. I know that many of the high street banks are maybe not kind of passing through those interest rate rises, but there are institutions that are. The post office I see is now offering a 3.5% interest rate. So I think voting with your feet is a really important part of the solution, and only when the bigger institutions feel the heat from competition will they start to move. So I think that's a really important thing. I think financial education, as Leon was talking about, really, really important. I think there's a space for that across all schools in the country. I have no idea why it's not mandatory that every school leaver at least kind of understands what a credit card is, what a mortgage is. I think that's a complete no-brainer. And then I think there are various kind of strands in financial regulation going on that I think we need to push forward with. Obviously, I'm sure we'll come on to crypto, but there are kind of new products out there in the market. I think we need to have proper financial guidance on what are appropriate products, because I think if you're, say if you're kind of coming up to retirement, I don't think crypto asset investing is maybe an appropriate financial product for you. And I think we need to make sure that the advice guidance review that's happening at the moment, that there are those kind of vehicles to make sure that people understand where they should be putting their money and making it work. And I think also we just need to recognise that financial regulation does come with costs. That if you're restricting lending to maybe kind of higher risk consumers, as we often talk about them, that does feed through to what financial products people can access. And that means that, for example, they might end up looking when, you know, to buy now, pay later. We had kind of high cost credits a few years ago. I think those things should, in some cases, I think, be discouraged.
Okay, thank you. Gerard, back to you.
Okay.
Presumably, governments of all colours want the population to be financially resilient, savvy, sensible with their savings, sensible with their pensions, and so on. What can a government actually do in terms of policy to change the culture and ensure that people are thinking decades ahead in terms of their financial planning? It's quite a big ask for a lot of people.
Yeah, I think it's very difficult for a government to micromanage. I wouldn't suggest the government should be micromanaging. I think Tom's point about economic growth is the most important thing for any government. To put it in perspective, pre-2008, the trend rate of growth in the UK economy meant that the economy doubled in size in real terms every 32 years. Now, there's difference of opinion amongst economists about where the trend rate of growth is, whether it's 1.25% or 1.4%. But in a nutshell, the economy will double in size every 64 to 70 years. So that's a big difference. The UK economy is in a very different space than where it was before. And if that continues, then unfortunately, we do start to be viewed as a low growth, low wage, low productivity economy. We're not unique. Western Europe generally is in the same boat as well. So getting growth rate higher is the key thing. Now, in terms of everyday life, for most people, the biggest single factor is either their mortgage payment or their rental payment. So addressing the housing crisis has to be a fundamental issue. Normally, these events, everyone asks, where's house prices going? But in terms of pensions, talking to Paul beforehand, Paul Goodman, one of the issues is that many people view their property as their best route to a pension. And they eventually sort of have a bigger property and then hopefully more expensive in their minds, and then they scale down at the end. So housing is seen as central to not only younger people's ability to actually have any spare money, but also for older people who might be seen as more financially literate, their ability to actually do things. So the housing issue is key, having a situation where houses, whatever the shape you live in or shape or size, doesn't become more expensive. So addressing the housing problem is key. Financial literacy, I do think we missed the point on financial literacy. It's basic numeracy and basic literacy. Back in 1997, it was 23% of school leavers couldn't do sums such as 50 plus 2. That has improved since in England, but I think it's deteriorated since in Scotland.
50 plus 2?
Yeah.
Oh dear.
But it was the same number, but it was the same number didn't have basic literacy skills. So there's something about people doing maths that age 18, we're trying to compete with skilled economies in East Asia, but at the same time, I think we need to actually focus on where the real challenge is. But lots of things. But having a period of economic stability where people can see higher growth is key, and having an environment where, whether it's rent or mortgages, they don't eat up a disproportionate amount of your income is another key focus.
Well, it's interesting what you say. The government should avoid micromanaging, just instead foster an environment where people can make sensible financial decisions for their lives. Leon, should we go back to you? You obviously aim to help people, younger people, make good decisions for their financial future. How do you reach the hard to reach? Because presumably people who approach you are already less interested in doing well in this area.
Yeah, so the MyBank programs, the way that we get young people through them, there's sort of three ways really. First is through school, because that's the vehicle. Most young people are in school, so obviously school is a critical factor in that. The second is young people self-refer or get referred into us by social workers or youth workers or people that are connected to them. In some of our money houses, which are converted flats where young people come and learn about things like tenancy agreements and how to take a meter reading and how to convert the meter reading into whatever their bill's going to be and try and predict the energy prices and all the rest of it, Young people in some local authorities are mandated to come to us before they get their bidding number for social housing. So you can see how government can take a role in helping young people to access these programs. I think there is something in what was just said about the macro picture. I think the Joseph Rowntree Foundation said that 6 in 10 households couldn't afford an unexpected bill. So if we're talking about the majority of households who can't afford an unexpected bill, there's not a lot in their cash envelope that they can cut any further. One of the easiest things they can do is to compare their products, and one of our biggest funders is Compare the Market. And they say that lots of people know that comparing the market is the best way to deliver a package of around £1,000 to your household bills, which is the fastest route to savings for most households who haven't got spare income, but that no one puts in the time to do it because the complexities around switching, although they're getting simpler, put people off. So there's sort of like a half an hour, we reckon, about half an hour a year where people sit down and really think about what they're spending, what their expected outgoings and income will be, and trying to plan for that. But any economic shock can really deteriorate a household's ability to then save and to manage within that cash envelope. So we obviously need the cash envelopes for each household to be going up. And one of the easiest ways is to, as we said, to cut housing costs. And there's a whole range of policy things that, I mean, we could spend all day talking about that we don't have time for here. But in terms of accessing people, that is difficult. But for us, it's through, like I say, using schools because they're there, using other avenues where young people already are. So if they're part of the Scouts, for instance, they could do a badge in financial education now, as can a Girl Guide, because young people are going there. And actually, some of those young people are hard to reach because the Scouts network or whatever kind of youth centre or youth club they're a part of typically works with younger, hard-to-reach people. And then the last avenue is where government can have a little bit of control, especially at a local authority level, to say, before we give you your bidding number for social housing, go through this programme. And the impact is we see a reduction in young people who can't keep up with their rent payments and who then fail their tenancy agreements and get turfed out of social housing. So again, the programme does work, the evidence is there. But accessing young people is always going to be a challenge because there's loads going on in their life and we try and get them for 3 to 5 days. And actually, once they're in our money houses, they really do engage, they come back, our completion rate is quite high, but that initial first stage is a challenge that we are kind of tackling all the time.
Well, it sounds like you're doing fantastic work. We haven't got much time left, and I do want to get to some questions from the floor, because they're always the best. But just on that point, in terms of technologies that Leon touched upon there, Rebecca, just very quickly, if I can ask the rest of our panellists as well, what sort of technologies are you excited about in terms of making financial management on the personal level easier for people? Because there's so much out there, a lot of it's confusing. Some things are trying to rip you off. You don't know where to go sometimes.
Yeah. Excited about. I've already mentioned the pensions dashboards. I think being able to access your pensions information in a similar way to your banking is really exciting. I don't know about you, but on my banking app, I've got it set up so that it adds up if there's money left in the pounds when I've done spending, and it puts it into a saving pot. How great would it be if I could link that up to my ISA, my pension, and have a bit more control and understanding of where I'm putting my savings, and even getting prompts like, okay, you're reaching your ISA limit now, think about something else. I think something like that would be really cool. Obviously, you would need protections around that because there's always a risk with these technologies that people are steered towards decisions that are not in their best interests. But it's definitely an exciting time.
Yes. Ed, are you like me, obsessed with looking at your online banking apps and moving money around and trying to, because it's just there in your hand?
I actually am. Yeah,
I'm always on it. It's fun.
Yeah, I mean, I think technology plays a huge part in this, and I think we've talked about some of the longer term challenges like financial education, but I think technology is a real way to address some of these problems in the short term. And there's, and as Tom mentioned, and we're all conservatives in this room, we're big fans of market-based solutions, and I think people voting with their feet and moving to banks and challenger banks and app-based financial planning is a huge growth area. I mean, I've got a couple of apps on my phone, I don't want to mention names because you know, people might start moving there and they might reduce the level of their service. But but you know, I've got a couple of apps on my phone.
You've got to share your top advice on this panel.
So, you know, for example, you know, Monzo, Revolut, Chip, there's even some of the big high street banks like HSBC, for example. You know, they do provide financial planning tools. They provide savings tools. They prompt you when you're getting close to your limits or when you could be saving more. And I think, you know, the banks that do that best and financial companies that do that best will definitely corner the market and are a real way to address some of these problems in the short term.
Yes, I think the technology can encourage you to be more savvy with your money, but also the buy now, pay later can be a bit disastrous. I have my own experience of that. You forget that you signed up to pay that in 3 months' time or in 3 chunks. I'm going to go to the audience, sorry, to get a couple of questions because we've only got 4 or 5 minutes left, unfortunately. Does anyone have a question for the panel? Over here?
Thank you. Ooh. Okay. So I'm an architect. I worked in social housing, and I agree that government doesn't need to micromanage, and housing is key to going forward. However, but with the pension funds who are reluctant to invest in the real estate market due to price volatility, I would welcome Dr. Lyons and the panel's input on if government would consider a CFD wrap to stabilize it, allowing pension markets to invest in affordable housing directly. Thank you.
Thank you very much. Gerard?
I'm not sure is the answer. Yeah, I haven't looked at that in too much detail, but yeah. But in terms of the housing market, if one looks at it, one of the most interesting developments is not driven by the government. It's the whole blended mortgage market, which is finance available. Retail banks are happy to lend to 65, 70% of price. They don't want to take more risk. Indeed, they're constrained by lending beyond 4 times people's income. What one is now seeing is other potential lenders, investment banks and others who want to take shorter term but increased risk coming into the mortgage market. So I think the important point is having the finance available to allow people to access the mortgage market. For instance, I'm a big fan of the idea that we should really embed rental history as an ability for people to use that to access the mortgage market. So in that respect, 100% mortgages, in my view, are not a problem if you do the appropriate risk assessment beforehand. But coming back to your question, it's very much about this. When one looks at the property market, everyone says it's about supply. But of course, demand and the change in the household unit is a key factor. So bringing more finance into the market, planning's been mentioned earlier, all these issues out there on the table. I'm not sure about the regulatory changes that you touched on, but yes, but the fiduciary responsibility of pension funds is always the first issue when you speak to people on pension funds about being pushed into this area or into the green agenda. Obviously, people respond to incentives at the end of the day, so it's about incentivizing people into the market. But as to whether that should be a regulatory change, I would need to come back on that. Thank you.
Anyone else have any thoughts on that one?
I mean, just one thing to add. I mean, I think we're still in the kind of early stages of this process. There are firms that we know are investing in kind of social housing, and I think that's definitely something to be encouraged. I think we also need to look at the kind of the types of kind of vehicles they can actually invest in, because I think a lot of the challenge is often actually how do they allocate their money towards social housing, because it's quite difficult to find those vehicles. Things like the long-term asset fund that the FCA has developed, I think, could be a good thing, though it's still early days. So yeah, we need to see how those things like that shake out.
I wonder if we can squeeze in one more question if we have over here. Just very quickly, it'll have to be.
Hi there, my name's Simon Bone. I've got a quick question to the panel. To what extent do you think the coronavirus pandemic, remember that, has on inflation, and obviously the government did some great work in helping support businesses and the employed, but now the money's being paid back. Should we be a bit Swiss and essentially destroy that money?
Well, who would like to take that one? Big question. Any thoughts?
I testified to the Treasury Select Committee the other week on quantitative easing, which is the bulk of this question. The way I described it was the good, the unnecessary, and the bad. The good, the quantitative easing immediately after the global financial crisis, the unnecessary being the prolonged periods of cheap rates, cheap money, and the bad being the response in terms of the Bank of England to the pandemic, because it was a supply-side shock, and they responded as if though it was a demand-side shock. So on the monetary policy aspect of it, that was a problem. It's now been corrected. QE needs to be replaced by quantitative tightening, but the speed, the scale, the sequencing of your monetary policy tightening needs to be very sensitive to the economic environment. Two wrongs don't make a right. It was wrong to basically do what we did on monetary policy 2 years ago. The second wrong would be to try and correct all of that overnight, because the economy is in a very fragile state. So you need to be careful on that. But in terms of the government's fiscal response, I think that was very admirable. And if one looks at the employment conditions in the UK, and indeed those in full-time employment, we know that some people have left the labour force since the pandemic. But the government's response, I think, on the fiscal side was necessary and actually was justified. Obviously, we now need to get back to the strong growth to actually see the fiscal numbers start to improve significantly.
Well,
but that's how I would respond to that.
The government's pandemic response. Now, that would be a topic for another panel, I'm sure. Thank you very much indeed. That's all we've got time for on this one. Thank you to my panel, Dr. Gerard Lyons, of course, Leon Ward, Rebecca Deegan, Tom Harrison, and Ed McGuinness. Thank you very much indeed. Thank you.